Singapore will pump $5 billion to boost the equity market. It's all part of measures to increase investor interest and attract potential listings. Under the program, the central bank will invest with selected fund managers who have a strong focus on Singapore stocks. Nashra Rohim with this report.
This is the first set of measures recommended by the Equities Review Group, which was first set up last August. The schemes fall into three broad categories: increase investor demand, attract listings, and make it easier for companies to go public. Tax exemptions will be given to fund managers who allocate at least a third to local equities. Family offices must also invest at least $50 million on approved Singapore exchanges. The aim is to attract high-growth companies that may have been ignored elsewhere.
Think about the tech companies, the biotech, the fintech, the medtech, the edtech, and I can name many more. Think of those who are in robotics, those who are discovering and inventing new business models. We would like these companies who operate here and in this region to anchor themselves here, to build their brand equity here.
Then there's investor education, with the Monetary Authority of Singapore looking to deepen research coverage of listed companies, especially small to mid caps. These proposed measures have already caught the eye of large companies like Razer, which says it's considering listing its financial payments arm Few in Singapore.
We will look at whether there are enough support, not just from the government in terms of initiatives, but support in terms of, whether there's investors who would actually look at such a business out here in Singapore. Are there research coverage that would support, again, the profile of the company and obviously relevance to the region?
SGX Group CEO Loh Boon Chye says the initiatives announced so far will jumpstart more capital and stimulate interest in local stocks and listings. Temasek CEO Dylan Pillay adds that the changes will need to be phased in so that investors remain protected. During the media briefing, Second Finance Minister Chee Hong Tat revealed that more plans are underway.
In the next phase, we want to focus on the following key areas. First, introducing programs to uplift listed companies' shareholder engagement capabilities and to sharpen their focus on shareholder value. Second, to attract retail liquidity through market structure changes, such as reducing the board lot size. And third, to strengthen investor protection through enhancing investor recourse avenues. Fourth, improving post-trade custody efficiency. And finally, to develop cross-border partnerships.
These proposals will first go through detailed consultation with industry stakeholders before they are published by the end of the year.
Well, for more on the proposals, I'm joined by Neil Parekh, a member of the Equities Market Review Group set up by MAS. Now, he is also a nominated Member of Parliament. Mr. Parekh, thank you for coming in today. Now, it's not a very pretty picture as it stands, is it now? But how are these measures how significant are they going to be?
Jill, thank you for having me. I think these measures will make a significant difference altogether. There are different components of these measures. So first and foremost is a focus on increasing investor awareness as well as investor liquidity, which will help valuations. The second one is on the regulatory front, where going to be ecosystem friendly, enterprise friendly, along with strengthening the ecosystem, the protection for investors. And lastly, to improve the kind of companies that list in Singapore.
The quality of the companies that you want to see. So they are significant when taken together, as you said. But which of these new measures, some of which you have listed, will have the biggest impact? And are there specific sectors that you think they could attract?
The Equities Review Committee, which is under the chairmanship of Minister Chee Hong Tat, Second Minister of Finance, and the Deputy Chairman of MAS, view these measures holistically. So it's hard to slice and dice, to be frank with you, but perhaps if I had to pick one, I would pick the one that you highlighted, you started the program with, which is the $5 billion of new money coming in to various fund managers through the new program, which is the Equity Markets Development Program that is being put in place. I think that'll be a significant initiative that'll move the needle, that'll bring confidence into the system, that'll hopefully lead to more capital following that $5 billion. So it'll be the base of a much larger pool of capital.
Yeah.
So if I had to pick one, I would say that. But to be frank with you, the regulatory changes are quite significant.
Yeah.
And so are the incentives being put in place to get quality listings.
Well, to attract that capital and with the carrots that you have mentioned, what are the sectors that you think would be more attractive and benefit more?
I think it would be the high growth sectors. So, clearly technology, broadly speaking, will play a role. But within technology, you've got fintech. Yeah. I mean, certainly medical technology. We have a very good ecosystem here in that sphere. We got consumer tech is getting off vogue. We have many companies here in Singapore that are going down that path.
We talked about even Razer perhaps being interested in coming on board. Right,
Razer
absolutely.
Looking to come back. Yeah.
I mean, as with all plans, it's not always smooth going. What do you anticipate some of the hiccups to be?
Oh, I think, again, we got competition, so we got to make sure that we deal with what others are doing. But, all these steps are in the right direction in the sense we fully are aware that we have no magic wand. So if I may say, in Singapore, we punch above our weight in many sectors, and especially in the financial service sector. And perhaps on the equity listing side, we are not there as yet. So the view is to maximize our resources to really optimize our potential. Not to be in competition necessarily with the rest of the world, but really to do the best we can so that we punch above our weight in this sphere too, as we do in so many others.
Now, $50 million investment in Singapore-approved exchanges. Do you think that level is going to deter family offices, for example, from setting up here?
Well, it depends on the quality of investments. My answer is no, for sure. I think some of them are already fairly active in that sphere. So it's not one of those things where, it's a brand new initiative and it may be a disincentive for them at all. But at the end of the day, it's about liquidity, it's about valuation, it's about the ability to grow the wealth that is being invested into Singapore. And I think some of the things that are being put in place will clearly help that.
Yeah, I want to look forward a bit as well, because we're talking about a second tranche that you're looking at, second tranche of measures. How are discussions progressing on that front? Where are you today?
I think things are going well in that. We wanted to get a first tranche front in market because some of these changes, especially on the regulatory side, will require a fair amount of work and time.
Yeah.
Because we're going from 2 regulators to 1 regulator, which is a big change for Singapore. So the idea was to get the first tranche out, to get moving on the first tranche. But we have many things in the anvil in the second tranche, which we are working on right now, which you will hear about in due course of time.
All right, we look forward to that. Come back and speak with us then.
Will do. Thank you.
All right, thank you so much. I've been speaking with Mr. Neil Parekh from the Equities Market Review Group.